Good afternoon, everyone. We are Agile Capital, and we are here to introduce Florida Saves, our innovative solution to Florida's pressing retirement needs. With the challenges brought by COVID-19, rising inflation, and natural disasters, Floridians need access to emergency funds now more than ever. Florida Saves provides that lifeline, balancing both immediate liquidity with long-term retirement security. Our solution is built on a strong foundation of three essential components. First, our system, which is designed as a dual purpose savings model, integrating both emergency and retirement savings with distinct allocation of 35% and 65% respectively. It's crafted to support a wide range of income levels, offering automatic enrollment, flexible contributions, and incentives to encourage consistent savings. Secondly, our investment strategy, which balances between liquidity and growth. Emergency funds are held in low-risk, high-yield account for quick access, while our retirement fund is diversified to focus on long-term growth and stability. Finally, to validate our product, we ran a 5,000 scenario simulation over 35 years, confirming a 97% success rate, particularly for gig workers. To build our product, we began by examining the financial landscape in Florida. To begin, Floridians faced significant expenses with over $400,000 spent only on housing and utilities per lifespan. As a result, our system provides accessible solutions to help manage these costs while saving effectively. Additionally, with women living to 81 and men to 75, sustainable saving are essential. Therefore, our approach secures retirement funds for longer lifespan. Moreover, income disparity is evident, with almost 25% of households earning under $30,000, while only 7% earn over $200,000. Consequently, our flexible system is designed to support all income levels. Finally, with 34% of residents over 60, we prioritize both emergency and retirement funds, ensuring financial stability as Floridians approach retirement. Now, Saad, can you please walk us through the product?
Of course. We developed a tailored sidecar model that combines short-term emergency savings and long-term retirement goals. We specifically built this model with the aim to lower the probability of participants tapping into their retirement funds, while providing them with features such as alternative investments, lower fees, and greater returns, features that are not easily accessible to the individual investor. Florida Saves will offer automatic enrollment for all workers, including gig workers. We simplified this process, which now occurs when an individual starts a new job, signs up on gig platforms like Uber and DoorDash, or files their taxes as self-employed. Participants can also opt out and re-enroll at any time without restrictions. As for contributions, and based on our simulations, they are optimally split, with 35% directed towards the emergency savings account and 65% towards the pooled retirement fund. Once the emergency savings account reaches its limit, all future contributions will be directed to the retirement fund. But how much will participants contribute and save? Well, we tailored both the contribution rates and the emergency savings account limit based on our participants' income level. And aligning our strategy with the industry average and the Secure 2.0 Act, the lowest income bracket will contribute 6% of their income and will have an emergency saving account of $1,000. Whereas the highest income bracket will contribute 8% and will be able to save up to $2,500. By achieving realistic saving goals, we encourage our participants to build a financial buffer, especially for lower income individuals such as gig workers. As for our withdrawal policy, withdrawals are capped at 60% of the emergency savings account prior year balance, with any additional withdrawals requiring approval. As for the incentives, we offer a 10% state matching on contributions upon reaching the emergency savings account, upon reaching 50% of the emergency savings account target. And we will reward consistent savers with an additional 10% withdrawal option. Let's now focus on Olivia. She's a 35-year-old gig worker in Florida. She is automatically enrolled, and based on her income level, she contributes 6% to Florida Saves. Of her contributions, 35% are directed to her emergency savings account and 65% towards the pooled retirement fund. Once her emergency savings account reaches its target of $1,000, all of Olivia's future contributions will flow into the retirement fund. Eventually, when Olivia needs liquidity, she can withdraw up to 60% of her emergency savings account prior year balance. However, her future contributions will funnel back into her emergency account until it reaches the cap again. As her income grows, As her income grows, she can increase contributions, keeping both short-term savings and long-term retirement goals on track. Now I'll hand it over to my colleague.
Thank you, Saad. Moving on to our investment strategy, we have two key components: the emergency savings account and the pooled retirement fund. The emergency savings account is conservatively managed, prioritizing liquidity and safety. Those savings are invested in high-yield savings accounts and in money market funds, which balances liquidity with modest returns. Moving on to the pooled retirement fund, we hold a diversified mix across 6 asset classes. 45% invested in listed equities, 24% invested in fixed income, and 26% invested in alternative investments such as private equity, real estate, and commodities. Now, this setup takes into consideration the age disparities of our subscribers. Therefore, it is an average allocation of 3 different allocations that are tailored to our subscribers' age groups. This allocation helped us achieve a Sharpe ratio of 57%, which was prompted from an expected rate of return of 9.3% and a standard deviation of 13%. Starting with listed equities, which constitute 45% of our portfolio, we diversify geographically, with 70% invested in the US and North America, 15% invested in Europe, and the rest invested in Asia and the Gulf. We also diversify across sectors, with our investments skewing slightly towards defensive sectors, which tend to perform resiliently during adverse economic situations. For fixed income, we hold a blend of US and EU treasuries, corporate bonds, bond ETFs, and TIPS. Now, these bonds are diversified across different investment grade ratings, and our fixed income portfolio targets an average duration of 11 years, which helps us capture returns from anticipated rate cuts and lock in higher rates for extended periods of time. Moving on to our alternative investments, we invest 5% in commodities for inflation protection, 10% in real estate and infrastructure for long-term resilience, and 11% in private equity to benefit from long-term returns and the illiquidity premium. Risk management is central to our approach. We rebalance biannually, manage liquidity, and maintain diversified positions. In addition to that, we integrate ESG factors and considerations into our investment criteria. And this fuels our long-term growth and sustainable investments. I'll hand over to my colleague for the simulation details.
Let's now evaluate the success of Florida Save's retirement plan. For that, we conducted Monte Carlo simulations to assess the financial model's sustainability and performance over 35 years with 5,000 scenarios and tested various withdrawal patterns. Our first simulation focuses on individuals with a low starting income of $30,000, similar to the case of many gig workers. For this group, we've set a retirement fund benchmark of $70,000 as the success criterion, following JP Morgan's recommended guidelines for retirement portfolio balance at this income level. The graphs emphasize the importance of careful withdrawal management to preserve retirement savings, especially for lower income participants with a 45% decrease in median balance from low to high withdrawal scenarios. The Florida Saves program effectively balances short-term needs with long-term savings, achieving success rates of 97%, 98%, and 100% for high, moderate, and low withdrawal scenarios, respectively. The Florida Saves plan effectively supports significant retirement fund growth across income levels, regardless of withdrawal strategy. For example, for a $75,000 income, the 25th percentile balance surpasses $500,000. This demonstrates strong financial security and a balance between immediate needs and long-term savings. Withdrawals are limited by a $2,500 cap, meaning that as income and contribution increase, the cap represents a smaller portion of the total amount contributed. This structure promotes wealth retention as the cap keeps a larger share of funds invested, allowing growth through compounding, which supports long-term financial stability by encouraging funds to remain invested as income rises. To summarize the simulation results, our simulation underscored a high emergency savings stability, success rates nearing 100%, with a strong impact on lower income participants, similar to gig economy workers. Additionally, the plan delivered controlled withdrawals. It offered necessary access to funds without disrupting long-term growth, even under moderate to high withdrawal scenarios.
In conclusion, Florida Saves effectively addresses all key case questions. The sidecar model offers accessible emergency fund alongside long-term growth through a diversified investment strategy. Auto-enrollment and income incentive-based encourages broad participation and tackle financial literacy gaps, while the 35% and 65% split balances immediate needs with future security. Thank you for watching. We're open to questions.
All right, does anyone have any questions? Yes, Mohammed?
Thank you, guys, for this presentation. I have a question regarding the matching scheme or the feature that you have included in this your solution. Could you please provide more details regarding this aspect?
Yes, that's a great question. So when you first thought about ways to encourage participants, especially gig workers, to stay opted in our program, we directly thought of a state matching on their contributions. And to elaborate more on that, on an emergency savings account, for example, $1,000 cap, upon reaching half of it, so 50%, we will contribute, we will match 10% of their next contributions. And this happens only one time, the first time they reach 50% of the emergency savings contribution. The other incentive that we also thought about was to give them an extra 10% withdrawal option from the emergency savings account, because we're restricting them to 60% of the previous year balance. So these two incentives are what we applied, basically.
Just if I can add to my colleague, this model is inspired by programs like New Zealand KiwiSaver, which also uses state matching to boost saving. Thank you.
Okay, and it is one-off matching.
Yes, it's one-off for the 10% on the emergency savings account contribution. Exactly. No worries.
Jennifer?
Thank you. It was very well presented. You mentioned lower fees in your implementation. How are you going to achieve that?
Yes, definitely. When we mention lower relative fees, basically we mean relative lower fees. So basically, one of the value-added services that we have in our portfolio is that it's a pooled portfolio. Therefore, it avoids the burden of each individual having an account on his own, and this also eliminates individual and single fees he has to incur when he wants to transfer money into his account and then buy the stocks themselves. And this is basically what we mean when we reduce fees for a big and large cap fund, which is pooled.
Kaviz?
My question was regarding the saving account. So, for example, for the lower branch is $1,000, right?
Yes. Right.
Is it forever? Like 40 years from now is also 1,000?
If they join with an income of 30,000, we have income brackets. They will start with $1,000. However, if their income does improve drastically and they go to the second income bracket, we can change their emergency savings account cap.
But, so let's take the higher bracket. That's a fixed one. My point is in 10 years, it's still going to be the same amount.
Yes, it is fixed. However, he can withdraw and then replenish it later on. For example, if he has an emergency right now, that $2,500 can become $1,000. However, he will replenish it later on in order to fill his retirement amount, and then he could use the $2,500 again and again.
Right, I understand that. Yeah.
I also want to add one thing about the rationale behind it. We couldn't go higher than $2,500 because of the Secure 2.0 Act. And this act mandates a $2,500 limit on any emergency savings account that is linked to a pension plan. So we had to abide by it to make it actually feasible.
Okay, thank you. I have one more question also, is regarding your withdrawal kind of patterns. So can you walk us through a little bit of what kind of processes or functions or whatever it is, what assumptions you made behind that and how they work?
Yes, I can answer this question. Can you hear me?
Yes, we can.
Yes, regarding the withdrawal patterns, we considered the 3 withdrawal patterns, okay? For all of them, we considered uniform distributions, okay? But we changed the range. So for example, for a low withdrawal pattern, for a low withdrawal pattern, we took from 0 to 30% of the previous year balance. For the moderate, it was up to 60% of the previous year balance, and for the high withdrawal, it was up to 100% of the previous year balance. So used here uniform distribution, and we changed the lower and the upper bounds of this distribution.
Christine?
Yes, hi. Excellent presentation. I just want to make sure I understand correctly. So let's assume like we have some families losing their job and downturn. What's the maximum? Do they need to opt out to get their cash like that? That's not exactly clear to me, because it seems like there's risk that a lot of people need to opt out if they're really in need of cash.
Exactly. Thank you for your question. It's a very valid one. And I would reassure that isn't only in the case of a family if it loses its job, maybe in case of natural disasters and hurricanes such as the one that happened 1 month ago in Florida. Families would need a lot of cash. And we actually took that into consideration. And we offered flexibility to our customers where you can not only withdraw 60% from your previous year's balance, you can either withdraw 100% on certain case-to-case basis. In addition to that, you could even withdraw from your retirement account, which is the long-term pooled retirement fund. However, we're going to have to pay a 10% penalty on that. If the case is extreme and the families are in deep worse situation, then we could accommodate for them and maybe decrease the percentage depending on the case itself.
Milan?
Yeah, really excellent presentation, well thought out solution. One of the things that struck me was the differential approaches you've taken, or the individualization of the contribution based on income. But that could be a tricky business in the sense of, I would ask, why should I pay more than you in terms of the rate of my income? So could you explain to us why, from a design point of view, you chose that option, and what's the upside for me? If I'm at $101,000, I'm paying a different rate than if I were at 99,000.
Right.
What's in it for me? Why should I?
Thank you for your question. Okay, so basically let's start with our thought process when designing such changing contribution rates. So the first thing that struck our minds while calculating such contribution rates is the concepts, the economic concepts of marginal propensities to consume and marginal propensities to save. So basically, when you have a higher income, you have a higher marginal propensity to save, as your consumption that is required for day-to-day use and in order to live day-to-day and week-to-week is flat on a certain amount. And that doesn't change across income. So the basket you pay in order to live, to eat, that stays the same. However, when your income goes up, your marginal propensity to save goes up, and therefore people might be more inclined to contribute towards their retirement plans. Now, what's the benefit for the customers themselves and the employees or the pensioners? Basically, when you have higher contribution amounts, first of all, you're filling the short-term or the liquid jar faster. And when you do that, more money is going to be flowed into your retirement account. And when that happens, you'll be benefiting of longer period returns and higher returns over the long term, which is great on the retirement end. And when you look at it at 30, 35 years compounded, the average fund balance difference is huge if you contribute 6 and 8%. In addition to that, we also offer the option for people to increase their contribution rates based on their will. So you can deviate up to 3 or 4% above your set contribution rate, which is of course accompanied with a financial advisor, because some people might like to increase their contribution rates, but their financial situation doesn't help them to do so. So this option is going to have to be accompanied by a financial advisor that studies the situation of the individual and the family itself.
Thank you for your presentation. This was very interesting. So your success rates, I think that's what you're calling them, they're extraordinarily high. And I mean, I'm a bit of a skeptic. I've never seen rates that high. So I'm just wondering, have you looked into your expected returns? For example, assumption, have you peer reviewed your expected returns? Have you looked at maybe the contribution rate you're recommending? Have you debated how high they were maybe they're too high. Just curious to understand how your thought process went through as you're seeing these numbers. They're extraordinarily high. As you likely know, this is not typical in the financial industry. So tell me about that. Tell me how you debated it, and if you looked at your assumptions a little closer.
Okay, I'll take that. So first of all, starting with the expected rate of return, basically what we've done is that we calculated the average return, the average annualized return for each of those asset classes, which in the average asset allocation we have. So basically we multiply the average return on each of those. That's interesting. Okay, so where was I? Okay. So we calculated the average return through the proxies of those asset classes. So how have we done that for listed equities, for example? We took the S&P 500 with a slight skew towards defensive sectors, as we mentioned, and we found the returns and standard deviation for the last 25 years. The same happened for fixed income. We took the aggregate bond market. Private equity, we took the returns of the top 50 firms, and so on. Now, for the contribution rates, we actually benchmarked our contribution rates to the industry, which sits currently at 7.4%. Therefore, we altered our contributions between 6 and 8%. Now, for the success rates, they might sound a bit too over-optimistic, but as numbers, but we believe 3%, like in the case of high withdrawal, there are 3% of people that aren't meeting their retirement goals, which is still a lot. And we believe that is an area we'd like to focus on later, maybe to tackle some issues that might be hindering us to complete that 100%.
Jennifer?
You mentioned ESG in your implementation. Why would you add that to this proposal? And do you believe that ESG is going to be positive, or which way do you think that's going to do in terms of your returns?
Well, that was one of the hottest questions among the team. So first of all, what we basically do in ESG considerations is that we look at the ESG score of the company or the ETF and so on. Why have we done that? Because one of the main challenges of our retirement fund is stimulating people to stay in our fund. People don't like to save, people like to consume, so we have to give them a reason to stay. Now, I know, and we know, there are a lot of people that are environmental friendly and look for green investments as much as we can. If we can stimulate them through giving them this option of green and healthy investments and sustainable growth, basically, we could be protecting a big portion of our subscribers and our retirees.
If I can add to my colleague, so I think also the ESG investment that focuses on those sustainable companies reduces the exposure to risk linked to environmental or regulatory issues. So this approach aims to enhance the portfolio stability and ethical impact. Thank you.
Kemiz?
I just wanted to ask you, what was the thought process or how you got to this 35-65? Because if I look at it's just a question, if I look at the different tranches, it looks like if they do contribute their 6 or 7 or 8, essentially in less than 2 years every time they replenish. So we could do less than 35 and leave it 2-3 years to replenish. I mean, is there a reason that we're going to replenish right away, kind of thing?
Thank you for your question. Exactly. I can start with that and you continue. Okay. So basically, our thought process behind it was exactly what you said. We measured the number of years it takes to fill up this retirement account. Now, basically, gig workers typically have fluctuating incomes, and those fluctuating incomes aren't really stable for 3 years in a row. So when they're unstable for 3 years in a row, you're going to have to have a buffer or financial cushion where you can withdraw and spend at least for a couple of months. Therefore, we took 2 years as the average amount of time that it has to take in order to fill your account. And through backtracking process, an average Floridian who earns around $58,000 and contributes 6% to the 7% to the retirement fund has around 1.8 years to fill up his retirement, his emergency savings account. Thank you.
Hi, thank you for your presentation. It's very good. Just so I understand, though you set these contribution rates, 6, 7, 8. Are those the starting contribution rates, so that those are mandatory? So if I'm participating in this plan, I automatically have to contribute 6%. There's no sliding scale.
There is a sliding scale upwards, but you can't go down that
You can't.
contribution.
So if I
rate.
can't afford 6%, I'm not participating in this plan. Is that correct?
Well, I think this is tailored for you to afford that 6%. So basically, 6% out of a $30,000 income, which is the average income for a gig worker, is marginal, is around $1,800 annually. Or if you take it a monthly, it's like $150. So we believe that it is affordable. However, in the case where an employee cannot afford, we would actually advise him not to go into our portfolio, as contributing less than 6% disrupts the whole process of contribution and the flows of the money inside our funds. And the flow, of course, most importantly, and the flow between the emergency savings account and the pool retirement fund. As we were saying, the average is 2 years. If you want to contribute less than 6%, you're going to have to take much more than that. And I think a person who has such a low income would face an emergency in less than 2 years.
I'm just thinking of how you're trying to encourage people to save and to put money towards retirement and to provide something that's more of an incentive, even if it's a small amount, just to start that process. And I'm just questioning whether 6%, a mandatory 6% starting point, is going to be encouraging people to put money aside.
Yeah, that's a great point, and I just want to add to what my colleague said. The 6% is minimum. However, 35% of their contributions are in an emergency saving account, and this account is extremely liquid. So they are actually putting money aside, but these money are very liquid, and they can withdraw them without any restrictions. So we're just trying to help them to save more, both on the short term and on the long term. So that's why even if they can't afford the 6%, a part of it is still very liquid for them. They wouldn't feel like they're locking the money aside.
Rami?
Just one last thing, and you might have alluded to it, I just missed it, but the state of Florida gave you $30 billion to get you started. Where's that money? What do you plan on doing with it?
Okay, thank you for your question. It's a very valid point that we take into consideration also. First of all, 30 billion is a lot of money. And a big portion of our investment, of our asset allocation, is into private equity and real estate. And usually, those investments require large sums of money. So you can't access such investments with low cap. And this 30 billion allows us to tap into hardly accessed investments, such as buying out companies or buying out complex or compounds, residential compounds. Now, on the other aspect of repaying the loan, here we could see an Excel sheet that shows the average fund size over the years, and we calculate the management fees, which currently sit at 1%. And the management fees actually are able to replace or to pay this 3.5% interest over 10 years by around 70 to 80%. And the remaining 20% is compensated through the returns that we achieve from our portfolio.
So tell me where I can sign up to get 1% management fee. I think the standard is 220. But let's think about your asset allocation. Mm-hmm. Do you think that you are taking enough risk on the portfolio? Because you have the ESAA, which is all money market and fixed income, and you have your retirement fund that is, I think, close to what, 30% fixed income, with cash and fixed income, and listed equities another, what, 45%. So alternative investment, as you think of retirement, that's where you get the bang for the buck. Why, from an asset allocation point of view, your alternative is so low relative to standard approaches?
Okay, thank you for your question. First of all, the allocation shown on the main slide was the average allocation of the 3 different allocations we have depending on the age groups. So we have this allocation for people aged 20 to 35 years old, and this allocation for people aged 35 to 50, and the third allocation, which is dedicated to people aged 50 and above. So we could see the percentage of private equity, let's say, is increasing as you get low in age, and percentage of fixed income goes up as you get older. So this is where we account for the perfect level of risk that you could incur. Second of all, the average private equity being so low is that we also want to include liquidity buffers in a way or another, even in the retirement fund. As this is not only an untapped fund, it can be tapped with a 10% withdrawal penalty. So we believe that even the retirement fund has to be somewhat liquid in order to provide the necessary liquidity in times of emergency.
Okay, so really fascinated by this. But then when we go back to the contribution, contribution is based on income, but asset allocation is based on age. So that's a bit of a mismatch, no?
Exactly. That's a very, very valid point. But we thought that if we want to over-complexify our fund, we would first of all lose a lot of subscribers because they wouldn't understand where their money is going. And second of all, if we had to maybe design 6 or 7 different asset allocations, our fees would be much higher, and therefore the management fees that we have to charge our customers would be even higher, and therefore that affects the stimulation of the number of the customer base of our retirement fund, basically.
If I can add to this, Florida Save addresses the financial literacy gap by incorporating these automatic enrollment and the tailored contribution rates. And that's why we didn't complicate it and add the age theory to the contribution, just to make it more accessible and more tailored to their needs for now. Thank you.
Awesome. So thank you so much for your presentation. Let's give a round of applause.